I have come with module 9.3 where I am going to explain the exemptions of section 54 and 54B. These are important for capital gain computation. This, when we will ask questions also, you can get questions, questions. You can expect questions from this section also, that is section 54 and section 54B. Now, why I am telling some sections are important for theory and some sections are important for problem. So, I will explain it clearly which all sections are important for problem and which all sections are important for theory when I will explain the modules. So, this I am telling that sections 54 and 54B are important from the concept of doing the problems, full computation problems when you will do. So, this is very, very important. So, module 9 we have devoted for learning the computation of income from capital gain. In that module 9.1 we have learned the theoretical concepts, index cost of acquisition, index cost of improvement. These two basic things we learned in module 9.1. Module 9.2 we have learned how to compute short-term capital gain and long-term capital gain. Now this module we are coming to, after computing the short-term and long-term capital gain, the next step is computation of exemptions under section 54. So this module we are going to learn exemptions of computing capital gain using section 54 and section 54B. So here also I am going to explain this and some simple problems I have worked out just to explain the concept. So I told you this last module of capital gain computation will be full problems. In the full problem, we have to include questions from all sections where it is important from the point of doing problems. So that is why I am doing that, just to give you an idea about this sections and the exemptions, how you calculate. I have explained only simple problems in this module. When we will do the last module of this module 9, we will be doing tough problems where I will include all adjustments possible. Section 54 is capital gain arising from the transfer of residential house property. This is quite possible in the case of any individual or HUF. So they will buy the residential house property. When they will earn more income, they will sell that and they will go to a better house property. Or the self-accommodation or self-occupation, always they will prefer to live in a better house. So that is a human mentality. So this exemption, you have to remember that. Theoretical concepts also you have to remember. Please remember that only an individual or an HUF only can claim this exemption. Second point is this exemption is available only if the capital asset transferred is a residential house property. So in capital gain, we have learned that capital asset meaning it can be plant and machinery, furniture, shares, jewelry, land, residential house property, anything. But here you have to remember that if the assessee has transferred a residential house property, then only this exemption will be available. Now it should be a long-term capital asset. Now you know that what you mean by long-term capital asset. So short-term capital asset we have learned either 12 months, 24 months or 3 years. So more than 3 years we will be considering a capital asset. If it's transferred, it will be considered as a long-term capital asset. See, some sections exemptions are available for both short-term and long-term. In the last slide, I have explained the comparison between these two sections. Section 54 and section 54B. This is for the comparative study. So you can learn that these sections are also important. See, when you have to remember whether it is available for short term and long term. So this here I am stressing that this section is available only for a long term capital asset. See, for example, if you bought a house in 2020, 2021 or 2022, if you are selling that, you are not going to get an exemption because it's a short term capital asset. Now to claim, next point is to claim exemption, the taxpayer will have to purchase a residential house property. So that meaning whatever capital gain you got, you are investing in a new house property. So whether that can be an old house property or a new house property. Or another option is you can construct a new residential house property. Now what do you mean by old house property and new house property? Old house property meaning sometimes we may call it as people will do the desperate sale. See, now this lockdown period, some people they want to invest, they are not able to pay the EMI. So if they want to sell, they will sell at a throwaway price. So sometimes old house property will be available. So some people will buy that and they will remodify that. Some people prefer to go to a new property. So this is an option of the SSC, whether they can purchase a new one or old one, or they can construct a residential house property. Now, here you have to remember that the new house property should be situated in India. So if I'll sell a house property and if you buy property in Dubai, it's not available. This exemption we cannot claim. The new house property, what you are buying, it should be in India. So now continuing with the provisions, new house property should be purchased or constructed within the time limit given below. So I want to tell you this time limit, I'll tell you as 1, 2 and 3. So this point you have to remember. So many sections, all the sections you have to remember this time limit is important. 1, 2 and 3 for section 54. I'll tell you what is 1. The new house property should be purchased within 1 year before. When I'll teach income tax, always my students will ask how this is possible. 1 year before, how can you decide purchasing a house property? I will give you an example. See, for example, if we decide we are going to sell a house property and we are going to buy another house property. So what we will do, see, buying a house property is based on so many constraints, so many things we have to consider. Children's school, our place of work, husband's workplace, so many things. Nearness to the church, nearness to the place where supermarket, that amenities should be there, public parks should be there, good road facilities should be there, water, electricity, everything. So we will consider so many things. So what we will do, if you will decide we are going to sell a house property, we will start looking for that. We will see the advertisements, and sometimes we will come across a good builder is going to construct a new house property, but they may take 1 or 2 years to complete. So at the time of laying the foundation stone itself, they will start collecting the money. So if we are interested, we can go and pay the money. Remember that still our property we have not sold. So here what we will do is we will go and book one place there or one apartment there in that new building. So that is 1 year before it happened, because maybe after 1 year only we are going to sell the existing house property. So this is possible before 1 year. So that is the condition of 1 year, or within 2 years after the date of transfer. Imagine that buying a house property, it's a huge investment, and you cannot go to if you want to buy for daily provision, we can go to a supermarket, we can select the item from the shelf, whatever is displayed there. It is not possible for a house property. I told you so many constraints are there, so many factors we have to consider, then only we can do that. So here, sometimes after selling that, we may take 2 years to decide which property we are going to buy. So after selling your existing house property, you can wait for another 2 years if you're buying a house property, another house property. Or if you're going to construct a house property, you can take minimum 3 years. So here it's important 1, 2 and 3. 1 year before the sale of existing house property, 2 years after the sale of existing house property, or 3 years if you're constructing the house property, new house property. So these conditions are very important. So the new house property should be purchased within 1 year before or within 2 years after the date of transfer of the residential house property. Next point is, if the house property is constructed, the construction should be completed within 3 years from the date of transfer of residential house property. This is also very, very important. Now, what will be the exemption possible? Amount of exemption is equal to amount of capital gain generated on the transfer of residential house property. Now, what is the capital gain? See, I told you, if I am buying a house property for 20 lakhs, I am selling it for 30 lakhs. So, what is my capital gain? If, without indexing, if you take that, just 10 lakhs. I am not considering the indexing, just for explanation. So, that is the capital gain. So, after indexing and all, it's long term, always you have to do the indexing. So imagine the capital gain after indexing, you got 8 lakhs. So that is the capital gain that you have to invest in the new house property. So the amount invested in purchasing or constructing 2 new residential house properties. Remember that till the budget 2019, this was only one house property. 2019 budget has stated that these are the new provisions introduced in the 2019 budget. And this year we are going to follow this condition. So earlier it was only one house property. Now you are eligible to buy 2 new house properties. Plus, again, if excess capital money is there, or if you want more time to decide within this 1 year, 2 year, and 3 year period, you can deposit the amount in the capital gain deposit scheme. Now, what is capital gain deposit scheme? That I am going to explain in the next slide. capital gain deposit scheme. Just now I am telling you the basic explanation. This is a scheme specified for this purpose. That is, if you are getting capital gain and if you are not able to buy the capital asset you are looking for within the time of submitting the income tax returns, you cannot keep the money with you. What you have to do is you have to deposit in the capital gain deposit scheme. So where you can open that? Usually in the public sector banks. Now even IDBI bank is also allowing that. So from time to time, income tax department will give some private banks also the permission to open that. So whichever bank got it, if all the public sector banks got this permission. So you can invest in the capital gain deposit scheme. So what is the condition? It's like a lock-in period is there. If you want to withdraw money from that, you can utilize only for buying that capital asset. If you're utilizing money for anything else, you have to pay the tax. So this is the importance of capital gain deposit scheme. One side you are getting exemption from income tax. One side you can keep the amount safe in a public sector bank or in a bank allowed by the income tax department till you will purchase the capital asset. Now, next condition is the capital gain does not exceed 2 crore. So this condition is also important. This is also introduced in the section Finance Budget 2019. So if the capital gain of selling the house property is exceeding 2 crore, this provision is not applicable. Now, assessee can claim this exemption only once in his lifetime. He cannot claim it every year. Only once in his lifetime he can claim that. Now, Finance Bill 2019 has proposed this change. Now, consequences are there. You are claiming exemption from tax. Now, if you are doing some violation, then you have to pay the consequences. So, that is, if the new residential house property is transferred within 3 years from the date of its acquisition, completion of construction, the amount of exemption given earlier would be taken back. Always remember that 3-year lock-in period is there. 3-year lock-in period meaning the new house property you purchased, you have to live at least or you have to keep it in your ownership at least for 3 years. Before 3 years, if you are selling, whatever capital gain exemption you got, that will be withdrawn. That meaning you have to pay the tax, capital gain tax, whichever you claimed exemption earlier. So that is the consequence. Now, if the amount is not utilized for purchase or construction of the new house property till the due date of submission of income tax returns, then it should be deposited in the capital gain deposit account scheme. I told you, if you are not able to get what you are looking for of your choice, even if it's a residential house property or if it's a plant or machinery, anything like that, other sections you will learn other capital assets. So then you can always keep the money in the capital gain deposit scheme. So I'm going to explain that after this problem. So first problem I will explain. Mr. V purchased a house property in Bangalore in 1996 for 5 lakhs. He incurred the following expenses in the same year for the improvement of the house. Remember that 1996 value we will not consider. 2001 is the base for indexing. So 2001 value only we will consider. Now renovation of the house is 4 lakhs. Addition of 2 rooms in 1997, 6 lakhs. That also we will not consider. We will take the fair market value of the house as on 1/4/2001. That is 10 lakhs. Now he sold the house in May 2019 for rupees 50 lakhs. So that is the sale consideration. Fair market value is 10 lakhs and we are selling it in 2019 for 50 lakhs. Now he purchased another house property within 2 months for rupees 10 lakhs. I told you the conditions 1 year, 2 years and 3 years. I have explained that. So within 2 months he is buying, so he is eligible. Now he has also invested 5 lakhs in capital gain deposit scheme to buy another house. So I told you now LSSC is eligible to buy 2 house properties. So 5 lakhs, 1 house property he bought and 1 he is keeping the amount in the capital gain deposit scheme. Now compute the taxable capital gain if CII for 2001 and 2 is 100 and 2019-20 is 301. Now table showing the computation of taxable capital gain of Mr. V for the assessment year 2021. Now the sale price is 50 lakhs. I told you expenses on sale. Some problems it will be there. Whether it is there or not, you have to include in the statement. Because at the initial stage, if you are making a mistake, then the final answer will go wrong. You will not get marks for computation. Because in the first stage itself, net sale consideration itself will be wrong. So the full answer will be wrong. So always you remember that even if there is in the question or not, you include expenses on sale. In this question, it is not there. So net sale consideration is 50 lakhs. Now less index cost. Index cost is 2001 value we are taking 10 lakhs into 301 divided by 100. We will get 30 lakhs 10,000. Now it's long term because 2001 and 2019. I told you question will not mention whether it is short term or long term, and tax rates are different. It's your duty to find out whether it is long term or short term. So 19 lakhs 90,000 he got long term capital gain. Now he is eligible for exemption under section 54. So he has invested in new house property 10 lakhs. In capital gain deposit scheme he has invested 5 lakhs. So 15 lakhs he can claim exemption under section 54, and taxable long-term capital gain will be 4 lakh 90,000. Now capital gain account scheme I have to explain. Amount of capital gain under section 54, 54B and 54F. 54B you will learn in this module itself. 54F I am taking it as a separate module because the computation is very important. I am going to do different problems. When I will explain, I will take only one section in that module and I will do more problems. So which is not utilized by the SSC. I told you if he is looking for a capital asset and if he is not able to purchase one. So for the purchase of new asset within the time allowed for the purpose. So it can be 1 year, 2 years or 3 years. Can be deposited in an account under capital gain account scheme. Now that I told you, if till the time of tax returns you are not able to find the capital asset, so you can deposit in the capital gain deposit account scheme. Now deposit shall be made before furnishing the returns of income or within the due date for furnishing the return of income under section 139(1) is self-assessment, whichever is earlier. So whichever is earlier, you have to remember that within before filing the tax returns. So 139(1) is we are only calculating our taxes and if there is some arithmetical error and all we can change that. Income tax department will allow you to make the changes. So remember that before filing the tax returns you have to deposit this excess amount with you in the capital gain account scheme. Now deposit shall be made in an account with a bank or institution approved for this purpose. Now which are all the institutions approved for this purpose? All public sector banks, and IDBI bank is also eligible. Now continuing, amount deposited can be withdrawn for utilization in accordance with the scheme for specified purpose. So that is for buying the capital asset when you will find the one of your choice. If the amount is not utilized for acquiring the new asset within the period stipulated under the respective sections, unutilized amount shall be treated as capital gain of the previous year in which the period specified in the above provision expires. That meaning, if you are not able to buy the capital asset within the time period specified, then whatever amount you have deposited in the capital gain account scheme, you have to pay tax for the capital gain. Now, however, for section 54F, only proportionate gain will be taxed. That you are going to learn that. You have not learned that, you are going to learn that. Now, one section is clear, section 54. It's very important from the theoretical concept and from the problem aspect also. Theoretical concept, please remember, 2-mark question you can expect. What are the provisions of Finance Budget 2019 introduced for section 54? So, you remember that section capital gain, if not exceeding 2 crore, he can invest in 2 house properties and once in a lifetime only he can claim that. Now we are coming to section 54B. Capital gain arising from the transfer of land used for agricultural purposes. So here who all can claim? Individuals and HUF can claim this exemption. The previous also 54 also only individuals and HUF. Now it can be a short term or long term capital asset. Remember, section 54 was only long term capital asset. Here it can be short term or long term. So you have to remember that land used for agricultural purposes. That's very important. Earlier one was residential house property. Now agricultural land was used by the taxpayer or his parents for agricultural purposes for a period of 2 years immediately preceding the date of transfer. So you have to remember agricultural land. Either the SSC was using it for agricultural purpose or his parents were using for at least 2 years before the date of transfer. This condition is very important. If this condition is not fulfilled, he is not going to get exemption. Now the taxpayer has purchased another agricultural land within a period of 2 years from the date of such transfer. Now you see the change. First section 54, it was time period was 1, 2 and 3. Here it is only 2 years. Within 2 years, the SSC has to buy another agricultural land. It should be for agricultural purpose. The new land may be situated in rural or urban area. Whether it is rural area or urban area, it's possible. Now, continuing, if capital gain arises on compulsory acquisition of agricultural land by the government, then the time limit of 2 years will apply from date of receipt of compensation, whether initial or additional. You know that whenever government is acquiring something compulsorily, cases will be there. Then government payments, sometimes it can get delayed. So sometimes this time limit of 2 years will get extended if it is compulsory acquisition of agricultural land by the government. It can be for a flyover, it can be for road construction, it can be for a metro, anything like that. They can do the, you have to remember that sometimes government will acquire compulsorily the property. Now, what is the exemption available? Amount of exemption is equal to amount of capital gain generated on the transfer of agricultural land. Now, the tax liability is on the capital gain what you received. Now, if you are investing in a new agricultural land, that much exemption you can get. Plus, if excess money is there, you have to deposit in the capital gain deposit scheme. So, this is the condition. Now, consequences is there if agricultural land is transferred within 3 years. For almost all the sections, this 3-year ban is there, a lock-in period. If you are claiming tax exemption under section 54, next new asset you cannot transfer for 3 years. So, if they are transferring before 3 years or within 3 years, then whatever, if the new agricultural land is transferred within a period of 3 years from the date of its acquisition, amount of exemption given earlier would be taken back. That meaning whatever capital gain exemption you claimed, now you have to pay tax. Now, second problem. From the following particulars of Mr. K, compute the taxable capital gain for the assessment year 2021. Purchased agricultural land in 2002 and 3 for self-cultivation. That meaning it's for agricultural purpose. 16 lakhs. Sold the land on 10/8/2019 for 70 lakhs. Now purchased another agricultural land on 10/10/2019. You have to remember that 2-year time period he can use. He is buying it within 2 months. So that exemption he can claim. Now CII for 2002 and 3 is 105. CII for 2019 and 20 is 301. Now table, always problem should be in the table format. So you have to remember table showing the computation of taxable capital gain of Mr. K for the assessment year 2021. So sale price is 70 lakhs less expenses on sale. This is just to remember that it's in the format. If that item is there, it should be adjusted. It is not there. So net sale consideration is 70 lakhs. Now less index cost 16 lakhs. That is the purchase price into 301 divided by 105. That year of acquisition index. So 45 lakhs 86,667. Now LTCG, it's long term because 2002 and 2019 it's long term. 24 lakhs 13,333. Less exemption under section 54B. He bought another agricultural land within 2 months for 20 lakhs. So taxable capital gain is 4 lakhs 13,333. Now the last slide for this module is I am comparing the sections 54 and section 54B. So section 54 applicability individual and HUF. 54B is also individual and HUF. Now asset sold. In the case of 54 it's long-term residential house property. 54B it's urban agricultural land, long-term or short-term. It can be long-term or short-term. Now new asset is 2 residential house properties he can buy in India if the capital gain is not exceeding 2 crore. 54B agricultural land he is going to use for only agricultural purposes. If any commercial aspect is there, he cannot claim this exemption. Now conditions within, I told you 54 is 1, 2 and 3. Within 1 year before or 2 years after if the house is purchased. I have explained how we will get that 1 and 2. Or within 3 years if the house is constructed. In the case of section 54B, used by him or his parents for agricultural purposes for the last 2 years prior to sale. 2 years before the sale, either he himself or his parents are utilizing that property only for agricultural purposes. Now exemption is either capital gain or the amount invested in capital gain account scheme, whichever is less. Amount invested in the new capital asset, that is residential house property. If any balance is there, he has invested in capital gain account scheme, whichever is less. Similarly, for 54B, capital gain or the amount invested in the capital gain account scheme, whichever is less. So I hope that section 54 and section 54B is clear to you now. So this is the advantage, section 54 and section 54B. Theoretical concept also important, and it's always remember that this is important for problems also. So with this I'm closing this module, and we are going to the next module where I'm going to explain two sections. Section 54D and 54GA. The next module I'm coming with the two modules. The section 54D and section 54EC. Those also, section 54D and 54EC are also important from the point of view of doing problems and theoretical concepts also. So this is, I'll tell you where it is important. So you can concentrate on that when you're doing the learning. So that is the advantage. So I hope you understood this concept. Two simple problems we worked out just to explain the concept. The difficult problems we are going to do in the last module, where I'm going to combine all sections, because one full problem for capital gain, you will get SSC has sold so many capital assets. So many exemptions it has to come into picture. So that module only I can explain the full problems. So the last problem I'm going to do full problems, and now next module I'm going to do section 54D and 54EC. So that also you will find it easy. Theoretical concepts I have explained, one problem each I have explained. So thank you for watching, and keep watching that. And I have done one important thing that you have to remember, Alice Mani educational videos. I have started a YouTube channel. You can subscribe to the channel and you can see that full income tax syllabus. YouTube videos, it will be available, and other subjects also will follow. So that will be useful for your learning. So thank you for watching, and please see the videos and do the problems in your notebook. Write the theory in your notebook. Don't keep this video for learning. You should have a notebook. That is how you can learn the subject. So that is why I will see in the next module. Thank you.